Hi everyone, and thank you all so much for joining our Tink Out Loud webinar. My name is Karina and I work in marketing here at Tink. So before we kick off the session, I would like to share some information and instructions for the webinar. All participants will be muted during the sessions, but if you have any questions, please do not hesitate to submit them via the question tab on your right in the GoToWebinar console on your screen. We will also have approximately 15 minutes for the Q&A session at the end, and we will try to get through as many of the questions as possible. Now, without further ado, Jan will be discussing the use cases and opportunities driving open banking investments. Over to you, Jan.
Thank you, Karina. And once again, a big warm welcome to everyone joining this webinar from around the world. Let me remind you that this is an opportunity to ask all of your questions, and we will be talking about the investments that financial institutions are making and the use cases that they're literally banking on, no pun intended. So please make sure that you do use that Q&A box on your webinar console. I'll have time to respond to a number of the questions, but if we don't get to your questions, I will personally follow up with you to make sure that none of the questions go unanswered. And so to answer maybe some of your first questions, yes, we will be sharing the slides and the recording after this presentation. But if you want to take screenshots for your own notes or to share them on social media or LinkedIn, that's fine too, of course. Now, as Karina said, my name is Jan van Vano. I work as the research director here at Tink. I joined Tink about 2 years ago when the open banking shift was just starting, and when Tink had just decided to really become that open banking platform for the European market. When I joined Tink, I remember thinking that open banking was going to be that next frontier in the financial services industry. And now that I am in a unique opportunity to look at how open banking is maturing globally, to be honest, it's I've seen some hiccups along the way, but it's quite clear that this has become a more exciting area than ever before. I think let's not forget that we are in the middle of a crisis that no one could have predicted, and it is impacting millions or billions of people around the world. In June 2020, the IMF, the International Monetary Fund's World Economic Outlook forecast projected a global economic decline of 5% for the year. And since the lockdown, if we just look at the UK here, the UK GDP dropped nearly 11%. It's gone back up a little bit. We've seen numbers from the Italian GDP dropping even more than that. And we're starting to see some recovery in some parts of the world. But as the president of the European Central Bank, Christine Lagarde, says, the recovery is uneven and is uncertain. So not only will countries recover at different paces, so will society. The IMF and the ECB indicate that the adverse impact on low-income households in the S&P segment is particularly acute. And so when we think about that change and that recovery, I think the current urgency to provide remote and digital services means that more executives are looking into how open banking can potentially play a role in the digital transformation of their organization, and how they can use open banking use cases to deliver immediate value by providing remote access to services, improving customer engagement and financial happiness, financial well-being, and ultimately also to improve the return on equity and employee productivity. The story around open banking is that it describes a shift from, of an entire industry, a shift from closed to open, a shift from analog to digital. We define open banking as the exchange of data and services between financial institutions and third-party providers to deliver enhanced capabilities and experiences to the market. Now, in essence, that means that open banking is all about giving customers control and creating value for the customer. Now, for this webinar, I'll be talking about the third research report we released this year. Our first report addresses the shift in open banking attitudes. We found that the positive sentiment towards the open banking movement that I just described has increased by at least 6 percentage points compared to 2019. So today, we now know that nearly 2/3 of financial executives are overwhelmingly positive towards the open banking movement. The second report addresses the investments and spending financial institutions are making in the context of open banking. We found that the numbers are astronomical. Financial institutions say that they are spending in the range of 50 to 100 million euros on open banking. However, this also means that these investments are touching every single part of the business. For example, we know that a huge proportion of the spending is used to modernize legacy IT and to optimize internal processes. Only approximately 10% of that budget is actually used to create tangible outcomes for the customer. And I think the main conclusion from the second report was that open banking sits right at the core of the digital transformation that many financial institutions today are going through. And we're seeing, but today I'm actually quite happy to say that we have released a third report. On the 16th of September, we released a third report, and it puts a little bit more meat to the bone. So this report is all about where those tangible investments are going, and we're expecting these tangible investments over the next 12 to 24 months to really materialize. And so for this webinar, I'm going to be focusing and sharing some of the insights from this report and analyzing some of those outcomes. And I think it's really, so if you haven't read the report, this is really going to be a great snapshot for you for what's in it. So let's go into the main findings. All right, so here it is. We surveyed nearly 300 senior executives at regulated financial institutions across Western Europe, and we asked them to select the areas that they are investing in. Now, straight off the bat, you'll notice that compliance tops the list of investment areas. Financial institutions are investing in digital identity services, in KYC process automation, and transaction monitoring. It's quite a coincidence to find the first place shared between digital identity services and KYC, but overall we discovered that 71% of financial executives are spending their open banking budgets in these three areas. Now, why do we find compliance so hard, or these compliance-related use cases so high? Well, first of all, the requirement for strong customer authentication, the requirement for customer due diligence, and in the context of payments for transaction monitoring are common among nearly all financial institutions. But secondly, it's the minimum effort required to conduct business. If financial institutions don't invest in these compliance-related use cases, they risk non-compliance and being fined by financial authorities. So it makes absolute sense to see these compliance-related use cases so high on the agenda of investment areas for financial institutions. But what gets me more excited is to see what comes next. So when it comes to what comes next, we see that they're all use cases related to the customer experience. Financial management services, here on the fourth place, may include money management applications or accounting software integrations, and they're clearly high on the agenda for most financial institutions. We also see that onboarding process automation is high, and that banks are investing in multi-banking. Now, this is especially the case for challengers in the market, the challenger banks, as well as the upstarts in the retail banking space or in the lending space. And it's more about providing that seamless integration, seamless customer experience. What's also interesting is that we found that in the Southern European countries, they appear to be investing more towards customer-oriented use cases than many other countries. But one thing to me is actually really clear from this data is that the battle for the customer has begun, and executives that are not investing in these areas run the risk of being left behind. If they're only focusing on the compliance and the minimum effort required, they risk being left behind in the industry. So I think this is really showcasing that the battle for that customer has really begun. Now, after that, we also see that there's a strong appetite for payment initiation services, but primarily from the business or corporate context. Now, business and corporate payment services has historically been an important business for financial institutions in general, and we see an ongoing appetite for this. However, retail payment initiation is clear. It's not as high on the agenda. Potentially, this is due to the fact that the flows, the SCA flows, the redirects, aren't optimal yet. But we are seeing some practical use cases from basically account top-up use cases, which would be most of interest for payment service providers, for PSPs, and perhaps less interesting for credit institutions or mortgage providers. Now, after that, we see that there is an interest for risk-related use cases, but general risk scoring is higher on that agenda. So, general risk scoring is common among financial institutions as it may estimate risk on defaults, negative direct debits, insufficient funds for payments, but income verification and credit scoring are lower on this chart clearly. I would say these use cases are often related to or dependent on the line of business within the financial services segment, so dependent on the subvertical. And specifically, for instance, credit scoring is actually a compliance-related use cases to help prevent customers from carrying too much debt. So here I would say it's more specific to the line of business, but general risk scoring on the customer is something that's of higher interest to most financial institutions. And finally, one of the things that we have needed to conclude from based on this survey is that financial institutions are not entirely convinced by the financial companion proposition yet. The generic personal financial management capabilities, or the PFM capabilities, have become table stakes in many organizations, but the advanced use cases such as product comparison services in order to, for instance, compare interest rates to improve acquisition, or to compare subscriptions for subscription management services, are more important to PSPs and retail banks than other types of financial institutions. So what this is showing us is that many of these financial companion services may not be proven yet, but I expect that over the next 12 to 24 months, we are going to see a number of large financial institutions investing in this area. Now, I can imagine that, just getting a snapshot of what a use case describes isn't really giving you a full picture of where the opportunities are. So, let me remind you that we do have the definitions, and they can all be found in the report. So please make sure that following this webinar, if you want a little bit more information on those use cases, you download the report, because we have the definitions in that document. What we also have in that document are insights that compare basically financial institutions and the results by size of organization. You may see that there are some, overall they're quite similar, but there are a couple obvious differences by organizational size. Specifically, here, for instance, we can see that smaller organizations in orange have generally a stronger appetite for KYC process automation and focusing on the customer in the case of onboarding process automation. Clearly, they're focusing on being able to provide a compelling digital experience with the least amount of effort, create a very efficient digital operation at this point of onboarding. Also, we're seeing a strong interest from smaller organizations to potentially use open banking to outsource some compliance related issues. So also there's a big focus on using open banking for transaction reconciliation services, as well as transaction monitoring. Now, the report, we're not just looking at country organizational size, we're also looking at subverticals. And let me just point out two obvious differences here among challenger banks and payment service providers, which don't exist anywhere else. So across the board, in every single industry, we find a compliance-related use case being at the top of the list, except for challenger banks and for PSPs. So challenger banks clearly are in challenger position, are trying to attract customers and do this with as little barriers as possible. So they're making strong investments into using open banking to improve and automate the onboarding process. PSPs are currently being challenged, and they're seeing an opportunity of using open banking to become the preferred provider, the preferred platform, the preferred interface to the customer, and to mitigate the risk of being disintermediated by other PSPs. And I think those are two really interesting differences when you compare the different financial subverticals. Now, to better understand how financial institutions are responding to open banking, we interviewed a number of executives. So one of the people I spoke with was Michael Anseo, who's the executive board member at BNP Paribas Fortis, and the head of the Fortis retail bank in Belgium. Well, he explained that, for the group as well as for Fortis, the main point of departure will always be the customer. And so the areas of investment for the group and for Fortis will always be centralized around the areas that create value for the customer. And that starts off with creating an application focused around personal financial management, but then extends into the financial companion realm. Now, they're starting off with that, let's call it PFM 1.0, but already have plans of moving into PFM 2.0, and it's going to be really interesting to see how this evolves. Another discussion I had, an interview I conducted, was with the CIO, the Chief Information Officer at Poste Italiana, Guido Criozoli, I should say. They launched a service called PostePay a couple of years ago, and they recognized that they were not the only ones in the banking business, of course. However, and they're not the primary bank often to their customers, but they want to become the preferred interface to the customer ecosystem. So they're making investments in order to make sure that they do create that multi-banking environment and do create a preferred interface for their customers, so that in the future, their customers would decide to manage their finances, manage their lifestyle through the PostePay interface, which is going to be extremely interesting. And they've now closed partnerships with peripheral industries outside the financial services segment in order to further evolve this proposition. Now, to give you some concrete example of these investments, I just want to highlight some real life use cases. ABN AMRO is one of the largest banks in the Netherlands, and a company that has been known as being one of Tink's very first enterprise partners. Their primary aim has always been to help customers better manage their finance. They're using Tink technology to launch, and which has now become the #1 money management app in the country, with over 750,000 registered users, and it allows any bank customer to use it. So whether a customer is from Rabobank, Bank, ING, or another bank, they're all able to use this application. And this allows ABN AMRO to expand their reach. So outside the I think 2 million customers they have within the retail bank, and tap into the rest of the population of the Dutch market in the Netherlands, and provide personalized offerings and upsell and cross-sell relevant services. I think this is a really interesting example. Another great example is the Swedish investment bank Avanza. Now, they're using Tink as part of the onboarding process in order to transfer investments, but it's not your typical multi-banking proposition or your typical PFM proposition. So they're using Tink technology to fetch investment information and account information to make the onboarding process more seamless, more intuitive, and increase conversion by 150%. I think that's the type of metrics that we're really looking for. And I know of another example that has done something similar, a little bit more volume, but it's increased conversion by over 50%. So these are the types of statistics that I think really matter and are proof to the opportunity that open banking brings. And finally, here's the last example. And I imagine most Swedes on the webinar here will recognize the ICA brand as it is one of the most well-known supermarket chains in the country. So ICA Stammes is the retailer's loyalty proposition to get even closer to the customer. And ICA Stammes is part of that, is the loyalty program where customers can apply for a credit card and aggregate their bank accounts into the ICA Stammes app. Now, this application helps users, of course, manage their grocery and other financial expenses. But it also helps them to earn loyalty points and benefit from personalized offerings that are unique to the user. But what I find interesting here is that users can earn loyalty points on every Swedish crown spent on selected stores. So not just crowns spent within ICA, but also other selected stores where ICA has created a partnership. So they're really taking loyalty programs to the next level. And I find that extremely interesting. So in conclusion, I mean, if you look at the results from the report, it's quite telling that compliance continues to be at the top of the chart. And this makes sense because it is the most common area of investment for the financial services industry. But if we look down the list, we start to see that the battle for the customer has truly begun. And it is more vigorous in some segments and some countries than in others. So challenger banks and PSPs are clearly investing more in these areas than some other subverticals, as well as Southern European countries clearly investing a little bit more in these areas than some of the other Western European countries. But one of the things that one of the main recommendations from the report, and I think we can draw from these conclusions, is that going forward, in financial institutions should look at areas where they can invest where challengers in their market segments are currently gaining share, because those types of metrics of a 150% increase or improve of conversion, those are types of metrics that are going to make a difference. And I think the earlier financial institutions can invest in these areas, the lower the risk that they're going to be left behind. So with that, I just want to say thank you very much for your time and patience. And before I hand it back over to Karina for questions, I just want to let you know that it is not too late to ask questions. Like I said, we will follow up with you no matter the question. So if you'd like to engage with me directly, or you can contact me via LinkedIn or reach out via partnerships@tink.com. And with that, so let me hand it back over to Karina for questions. Karina, over to you.
Thank you for the insights, Jan, and thanks to everyone who attended our webinar. As promised, we will send out the follow-up email with a link to the recording of this session, as well as to the full report. If you want to see our previous reports, you can find them always at openbanking.tink.com. Now let me check quickly if we got any questions. Okay, so I think this one sounds interesting, Jan. Credit is seen as one of the bigger opportunities in open banking. Why don't we see credit scoring at the top of the list? Jan,
there we go. Yes, I saw that. I was muted. Apologies. So first of all, excellent question. So if you look at the financial services industry right now, I mean, most credit institutions have an existing and fixed structure and approach towards credit scoring. Every European member state has identified specific factors to evaluate in credit scoring. As well as a centralized database in order to track depth and creditworthiness of especially in the retail space. I think there's an opportunity for open banking clearly to make it to improve that process. But in times of crisis that we are right now, I think executives would tend to be a little bit more risk averse. So maybe seeing how this may evolve over the next couple of months. But in time, make investments. So I actually believe, and we believe at Tink, that this is going to be a huge opportunity, and there's going to be a lot of demand for open banking enabled credit scoring. I mean, in fact, we've made investments in order to prepare for this. I mean, earlier this year, Tink acquired Instantor, which is quite well known for its credit scoring proposition. And if you look outside of Tink and you look at other parts of the industry, we also see, for instance, in Italy, that CRIF acquired Strands, another PFM provider for the European market, clearly making a bet on using open banking to improve the credit scoring proposition. So I think the momentum is here, but it might take a little bit more time to materialize considering the crisis that we're in right now.
Thanks, Jan. I think we still have time for one more question, and here it is. So there is a lot of discussion regarding the quality of APIs and the adoption of open banking. Would you expect the ranking to change if the quality of the APIs will be better?
All right. Yeah, good question. Personally, I do think so. First of all, if the flows, how do you evaluate PEC2 APIs or the quality of APIs? I mean, at Tink, we typically do that with three primary overarching criteria. It's user experience, API performance, as well as data parity in comparison to the customer interface. Now, if we just focus on the user experience, because if the user experience would have been better, I think we would have seen the potential for not only customer-related use cases higher, but especially the payment-related use cases higher. Or at least the appetite for these use cases. If APIs were designed intuitively and create a seamless experience to authenticate, I think it would be able to support mass volumes and payments, and I would expect retail payment initiation to be not ranked at the bottom of the list, but actually higher among the top customer-oriented types of use cases. However, we need to be humble with the fact that this does take time. Yeah, I think compliance will be at the top of the list for a long time. But if the quality of the APIs would have been better, I would have expected some of these other use cases, like retail payment initiation, to be higher in the list as well. So I would have expected some differences there. Yeah, thanks.
Okay. Well, we still have 2 minutes left, so let me ask you the maybe very last one. What key trends do you think will continue to arise based on the findings from the report?
All right, pretty open question. Yeah, like I said, the battle for the customer has begun. So if you look at the extension of this, hopefully we'll see more concrete examples of the tangible examples of these use cases, where banks are literally, or financial institutions are literally taking the opportunity to operate as, not just as a financial institution, but as a third-party provider to customers across the customer journey. So one of the things I like to help executives understand is that open banking opportunities exist at every stage of the customer lifecycle, from acquisition through personalized marketing, comparing interest rates or product comparison services, to onboarding by fetching account information, fetching account holder name, or fetching personal details, and doing risk analysis, customer due diligence, improving the KYC process, customer servicing, financial aggregation, multi-banking, etc., all the way to customer support and embedding open banking technology and insights into CRM and service management solutions. So if you look at that customer journey, I expect open banking to start materializing at every stage of that customer journey. And hopefully by next year, we'll have a lot more concrete examples of what not only large financial institutions are doing, but also the smaller upstarts are doing in all of these areas. So that's really like the trend that I see based on the findings of this report.
Thanks, Jan. Well, I'm afraid that's all we have time for today. If we didn't have time to go through your question, or if you would like to talk to us, you can find the contact info on the last slide. Feel free to email us. And thank you all again for attending.
Thank you, guys.